On July 23, 2026, two of the most powerful companies on Earth reported earnings. Both of them beat expectations. Both of their stocks got destroyed. Tesla fell 14.5% in a single day, its worst single-day drop since March 2025. Alphabet fell 7.1%. Together, they erased $500 billion in market value in one session. It had everything to do with a number that is quietly becoming the most important story in financial markets. How much are these companies spending on AI? And where is the return? Chapter 1. The deal that just broke down. For the last 3 years, there was an unspoken agreement between big tech and Wall Street. The companies could spend as much as they wanted on artificial intelligence, and investors would reward them as long as revenues kept growing. It was a simple deal. Spend now, profit later. And for 3 years, it worked. The Magnificent Seven, Apple, Microsoft, Google, Amazon, Meta, Nvidia, and Tesla, collectively gained trillions in market value. Then, on July 23rd, the deal broke. Because what Alphabet and Tesla reported was not just earnings. It was a capital expenditure number that investors could no longer rationalize. For the first time since Alphabet's IPO in 2004, more than 2 decades of operating, the company reported negative free cash flow in a single quarter. That's where Wall Street hit the brakes. Tesla's situation was equally stark. Capital expenditure surged 142% year-on-year to $5.79 billion in Q2 alone. Full-year CapEx is now expected to exceed $25 billion. And free cash flow turned negative, a deficit of $1.1 billion. The stock fell 14.5%, its worst single day since March 2025. The Magnificent Seven index fell 4.8% on that single day, its worst performance since the tariff shock of April 2025. Total losses across the group came to nearly $800 billion. Chapter 2. The fear of Fed is falling behind on inflation. There's another player that can move the entire market with just a few words: the Federal Reserve. For most of 2024 and 2025, Federal Reserve, lower interest rates. But lately, that story has started to change. The U.S. economy has stayed surprisingly strong. Consumers are still spending. Energy prices have climbed. And inflation isn't cooling as quickly as many expected. Fed now faces the same uncomfortable question it has faced before. Do we keep rates where they are, or do we raise them? According to CME FedWatch data from July 6, 2026, there is a 72.1% probability of at least 0.25% interest rate hike by the December 2026 Fed meeting. When interest rates rise, investors suddenly have another option. Instead of taking risks in expensive tech stocks, they can earn attractive returns from safer investments like government bonds. That's why higher interest rates tend to put pressure on stocks, especially companies whose valuations depend on profits years into the future. Which means a rate hike does not just make bonds more attractive than stocks. It mathematically reduces what stocks are worth, even if nothing else changes. Chapter 3. Market is volatile. AI stocks are not behaving like normal technology stocks. They are behaving like options on an uncertain future. These stocks are extraordinarily sensitive to any new information that can move stocks extremely up or down, which is why a single earnings call can erase $500 billion in 2 hours. Not because the companies became bad businesses overnight, but because the price of the stock was pricing in perfection. And perfection is a very fragile thing to price in. The Shiller-Cape ratio, which measures how expensive the stock market is relative to long-term earnings, is currently above 37. That is near the highest level ever recorded outside of the dot-com bubble peak. And the concentration is extreme. The top 10 stocks in the S&P 500 now represent 41 cents of every dollar in the index, which means when AI stocks move, the whole market moves. That is why you are watching a 2% drop in the Nasdaq on a day when most companies are actually reporting fine earnings. The stocks that are falling are the stocks that everything else is built on top of. Chapter 4. The real takeaway. So, what does all of this actually mean? Should you stop investing in AI stocks? Or is this just another buying opportunity? The truth is, nobody knows. A few years ago, investing in AI felt easy. Every earnings report pushed stocks higher. Every new AI announcement sent billions of dollars into the market. And every company that mentioned AI seemed to get rewarded. Today, the game has changed. Wall Street isn't impressed by big promises anymore. It's asking much tougher questions. Can these companies actually make money from AI? Can they earn enough to justify spending hundreds of billions of dollars? Or are they spending more simply because they can't afford to fall behind? Because AI is no longer just about innovation, it's become a race. And in a race, sometimes the company that spends the most doesn't finish first. Just look at what's happening today. American tech giants are investing hundreds of billions of dollars into AI infrastructure. At the same time, Chinese companies are showing they can build competitive AI models using far fewer resources. If that trend continues, the biggest advantage US companies thought they had could become their biggest challenge. History has shown that over and over again. The dot-com bubble, the housing boom, the electric vehicle rally, every major investment story eventually reaches a point where investors stop asking, how fast can this grow? And start asking, how much is this actually worth? The companies that win won't necessarily be the ones spending the most money. They'll be the ones turning AI into real profits. And until investors start seeing those profits, don't expect the volatility to disappear.